Welcome, everyone. My name is Matt Evans, and what I want to do is I want to go through the startup financial plan process with you. It's an 8-step process that we're going to go through. And the financial plan templates that we're going to go through cover all three financial statements, which are the income statement, the balance sheet, and the cash flow statement. And the models themselves, the Excel models that I have, which are models 1 and 2, are extremely easy to print. In fact, you can print it right from the overview tab, the very first tab, by just clicking the link that highlights the print range. And then all you do is you go to file print. So it's real easy. Here's some other good news. I'm a retired professional and I'm available to provide direct support. So if you need help in the area of finance accounting, especially these financial templates, because preparing a financial plan is not easy. And a lot of startup business owners, well, I don't have a financial background. I'm not a CPA. Well, guess what? Reach out to me. I can help you out. All of these resources, as well as the link to schedule an appointment with me for direct support, you go to the website. The website's easy to remember. It's startupfinancialplan.com. There's hyphens in between the keywords so that when people put in the word startup financial plan, the website will come up. And what we're going to do is in this presentation, we're going to go through the 8-step process. And I'm also going to cover the financial statements themselves because I find that, frankly, most business owners don't really have a good grasp of the financial statements. So remember, the financial plan is a set of financial statements. So if you're trying to prepare a financial plan and you don't understand how financial statements work, then you're going to get lost. So we're going to talk about that in depth before we even get into the financial plans. So let me talk about, I guess, since you don't know who I am, my name is Matt Evans. I'm a retired financial professional. I live outside Washington, D.C. I think I've done just about everything you can in accounting and finance, all the way from bookkeeper, accountant to project manager. And I have a lot of firepower. I've taught at several universities. I currently teach a webinar for SCORE, which is Service Corps Retired Executives. And I've gone through a lot of educational training. I'm a Six Sigma professional. I've gone through Villanova University's program on business intelligence. I attended the Wharton Business School in Philadelphia. So I have a lot of firepower when it comes to accounting and finance. And if you need to do an in-depth understanding to see exactly what my background is, such as working at Grant Thornton, a public accounting firm, all of the courses I've published, you can find all of that if you want to do a deep dive on my background from the LinkedIn profile link that's on the bottom of the slide. So that's a little bit quick background about me. What we're going to do in this presentation, which is going to probably take at least 90 minutes, the first thing you got to do, you got to understand the financial statements, because if you don't understand the basic mechanics of the financial statements, then preparing the financial plan is going to be very challenging and difficult. So once we get past that first toll gate, that first milestone event in this presentation, which is understand the financial statements themselves, and then we can go to the basic steps. We'll go through an 8-step process, but just to kind of highlight the real high level steps is you're going to have to figure out the total required resources to start the business and how you're going to fund it. That's a big milestone event. We got to get that out of the way. And then there's a certain pecking order that we go in when we prepare the financial statements. So I would want to know the revenues and expenses first, covering base year one. That's a big milestone event to get this done. Then once I understand that, what resources, assets, do I need to put in place with the combination of liabilities and equity? That forms something called the balance sheet. And once I know the revenues, expenses, which form the income statement, and I know the assets, liabilities, and equity that form the balance sheet, once I understand those 5 major transactions, Then and only then would I do the cash flow statement, because they all impact the cash flow account, which is your business checking account, by the way. That's what I mean by cash flow. What goes in and out of the business checking account for your startup business. So, what is a financial plan? What are you talking about? Well, I'm talking about projected or forecasted financial statements over a period of time. We're going to focus on the first base year, because once I get that first baseline year out of the way, the out years become very easy to project and forecast out through certain growth assumptions. So that's really what I got to get. I got to get that first baseline year out of the way. That's the real hard part. And there's three financial statements that make up the financial plan. Again, the income statement, which summarizes revenue and expenses, the balance sheet, which tells me the assets, liabilities, and equity that the business has at a given point in time. And then the third financial statement that I'll prepare is the cash flow statement, which is the money going in and out of your business checking account. And once I get that base year one done, then I can apply some growth assumptions to get the out years. And I usually recommend 3 years of projections, because that's typically what a bank or other lending institution would want to see before they write out a check and give you money to fund your startup business. So why do you want to prepare the financial plan? Well, you need to know the total required resources to get the first customer and then to get to break even, because I got to cover the entire runway, which is get to a break even point. That's the life cycle of the financial plan that you're really going to have to execute against. Break even refers to a point in time when you have enough revenues, sales from customers coming in to cover your month to month operating expenses. I got to get to that point, and that's not easy. That can take years. Could take 5 years, 8 years, maybe 1 year, 2 years. It depends on what your business is, how much experience you have, what kind of competition, what kind of resources you have. But it usually takes a lot longer than most people think. So if you think it's going to take 2 years, it's probably going to take 3 or 4. If you think it's going to take 5 years, it's going to probably take 8 years. So just remember, it's going to take probably longer than you think. Plus, I need to allocate the funds properly in a way that I can get to first customer as quickly as possible. Because remember, I'm trying to get out of conceptual stage. You're considered a startup business until you get to first customer. You're a conceptual. And if you're in conceptual stage, you don't have one customer yet, you're high risk, which makes it harder to finance and fund the business. Get to first customer as quickly as you can to get out of conceptual stage, because I don't want to fund a concept, I want to fund a business. And once you get out of the conceptual stage and you have customers, then it makes it a lot easier to finance and fund the startup business. Okay, so we got to get to first customer very quickly. The financial plan also provides baseline metrics that we're going to use. We need to grow into a healthy gross margin, and we're going to talk about how to calculate the gross margin later in this presentation. It's going to be a big part of the financial plan. If you watch Shark Tank, you can see what happens. Go look at Shark Tank, the TV show. You see what happens when people walk in. They always ask, well, how much does it cost you to land the product? How much did you sell it for? They're going to these people will size you up in a heartbeat when it comes to your gross margin. You need to know what your gross margin is. It needs to get to a healthy level. We're going to talk about that in the presentation. And obviously you need a good, well thought out, airtight financial plan to get funding and financing from lenders and equity investors. And this financial plan also kind of forces you to think financially, because frankly, a lot of small business owners, they're not financially trained like I am. I'm financially smart, but I'm not a marketing person. I'm not a business development person. I'm a finance guy. But that's a real Achilles heel for a lot of startup business owners. So going through this exercise, going through this presentation, and going through the templates is going to make you a lot smarter financially. Try to get through all of this. Even if you need my help or whatever, it's going to make you a lot smarter financially. And that's probably a big weakness that you have. that you need to cover as quickly as you can. You know, one of the things I find when I mentor people through Service Corps of Retired Executives, and I think I've mentored over 500 people in the last 6 years, they kind of loosely use financial terms. So I want to spend just a couple of minutes on financial terminology because the words that you use have very specific meaning. You got to be careful about the words you use. Let me give you an example. For example, if someone comes to me and says net revenues, they use the word net revenues. Well, that has, to me, I'm a certified public accountant. What that means to me is gross sales revenue less write downs to get to the net sales revenue number. Write downs like, well, the sales revenue number is overstated because a certain percentage of people never pay their invoices, or a certain percentage of products are returned. That's what net revenues means to me as a CPA. But oh no, I meant profits. That's what I meant to say. Well, you got to be careful. If you meant profits, say it. Profits, earnings, net income means the same thing. Net revenues and gross revenues has specific meaning to a CPA like myself. Just like the term projected or forecasted or pro forma financial statements means the same thing. Capital expenditure, capital deployed. Those words actually are not the same thing. Capital is the funds deployed and used to finance and fund the business. A capital expenditure means a physical, tangible asset. Capital asset or tangible physical asset that's used in the business. Restaurant equipment in a restaurant. Vehicles in a landscaping business would be a CapEx or capital expenditure in the business, okay? So tangible assets and intangible assets. So you have two kinds of assets in your business model. Tangible physical assets, restaurant equipment, vehicles, a building. Intangible assets are not physical. That can be patents, trademarks, copyrights, and goodwill. Those are the four common intangible assets. And the tangible and intangible assets are written off over their useful life through depreciation and amortization. That's the process of accounting. Okay, so we need to understand that. And as we get into the financial plan, you'll start to see how we do that. So these are things you need to understand just to understand how this financial plan is going to work. Okay. We're going to talk about the three financial statements first in this 90-minute presentation. Then we're going to go through step 1, startup costs, the funding plan. Step 3 is the estimating the sales revenue. Estimating all the expenses is step 4. Then we're going to compile the income statement once we know the revenues and expenses in step 5. Then there's a tedious detail step 6 where we have to post entries to figure out what the balance sheet is. And then step 7 is just compiling the cash flow statement per the entries in step 6. And then once I got all of that out of the way, I've got the financial statements done. The 3 financial statements are done at step 7. I got the base year 1 down. Then the step 8 is, okay, what are your growth assumptions for going into the out years? That's the 8-step process. These are the things we're going to talk about in the 90-minute presentation. Okay, so let's talk about the financial statements first. There are 3 financial statements. We'll start with the income statement, then we'll move to the balance sheet, and then the cash flow statement is last because there are five types of transactions in running your business. I also find, unfortunately, I think some people, for some reason, they seem to think that there's only 2 kinds of transactions in running a business. I run into this a lot now and then. People say, well, everything's either income or expense. That's false. That is absolutely false. There are 5 types of financial transactions in running your business model. And they cover 2 financial statements, the balance sheet and the income statement. And they are assets, liabilities, equity, revenues, and expenses. And if you understand how the accounting model works, you're going to understand the financial statements. So let me just explain this to you in real simple terms. The way the accounting model works, and it's very, very airtight, very linear, it's very rule-based. It basically says the following. You invest in assets, restaurant equipment, trucks for your landscaping business, a building, your business checking account. You invest in assets for one reason and one reason only, to generate revenues. That's it. That's how the accounting model works. There's only one reason you're putting money into assets, to generate revenues. That's all there is to it. And the way that you fund and finance the investment in assets, you only have two choices in the accounting model, and only two. Liabilities, which is debt. You're obligated to pay the money back to someone like a bank loan, or you put your own money into the business, your own equity. That's called equity, ownership equity. So the assets are funded and financed through the combination of liabilities and equity to drive revenues, which is sales to customers. Then expenses can be just about anything to run the business. Marketing can be Facebook ads, I mean, all kinds of stuff, legal fees, paying people on payroll, paying subcontractors, uh, any kind of expense to run and get the business up and running that's legitimate. If it's an ordinary necessary expense to generate revenues in a business model, it's a deductible expense according to the Internal Revenue Service, okay? So if it's business related, deduct it, put it into the financial statements. That's how it works, okay? Now there are some things that probably you shouldn't be going through your business checking account. Political campaign contributions, anything that's personal, has nothing to do with your business. You need to firewall it off. Anything personal goes through your personal checking account. Anything business related goes through your business checking account. Okay, that's how we need to work this whole thing. So the income statement is going to summarize all revenues and expenses for the reporting period. Typically, the reporting period is a calendar year because that mirrors and aligns to your tax return. Your tax return is usually prepared during a calendar year, so the income statement is often prepared during a calendar year, so it kind of aligns to that. And simply the difference between the total revenues and the total expenses for the reporting period is a profit or a loss. If you have more revenues than expenses, you got a profit. If you got more expenses for the calendar year than revenues, you got a loss. Profit and loss. And that's all going to get reported and summarized on your tax return, your business tax return. So you absolutely must prepare an income statement. I don't care if you do minimalist bookkeeping. As a minimum, you must prepare an income statement so you can do your tax return, okay? And we'll kind of harp on the tax return just a little bit on one of the slides in this presentation. But the good news is once I get that income statement out of the way, I can go to the next big step, which is basically the balance sheet. And probably the hard part in trying to figure out the income statement is going to be trying to project out what you think you can sell at what price. And we'll talk about that later here in the presentation. So the income statement summarizes revenues and expenses for the reporting period, which is usually a calendar year. Then I have the balance sheet, which is going to tell me the assets, liabilities, and the equity at any given point in time. And if we're on a calendar year basis, that would be on December 31st to cover the calendar year January 1st through December 31st. We also will break out the assets and liabilities between current and long term. So if something is going to convert and pass through your business checking account in 12 months or less, it's going to be classified as current, like a receivable or inventory. Inventory is an asset. You'll probably sell your inventory, let's say, in 90 days or less. It's a current asset. But maybe an asset like restaurant equipment or vehicles in your landscaping business is going to last 5, 10 years. It's a long-term asset. Likewise, the same with liabilities. If you got invoices you got to pay in the next 30 days, that's a current liability, sometimes called accounts payable. But if you got a bank loan that's 5 years or a mortgage on a building, that's a long-term liability. And owner's equity is contributed capital. The capital contributed by the owners in the business. So there'll be a contributed capital account that will be showing up in the balance sheet. So all the money that you put in, and if you withdraw money, we have a capital withdrawal account that kind of counters that in the owner's equity section of the balance sheet. So the balance sheet is going to tell us the assets and how we fund and finance it through liabilities and equity. And once I know that, then and only then can I go to the cash flow statement, because I need to know what those 5 types of accounts transactions are. I need to know revenues, expenses, assets, liabilities, and equity, because all 5 of those are going to touch your business checking account. So once I know the income statement and balance sheet, then and only then would I prepare the cash flow statement that shows the money moving in and out of your business checking account. What are the sources and receipts of money coming into your checking account? Sales to customers, a bank loan, contributed capital. 3 examples of cash going into your business checking account. Money going out of your checking account. Those are uses or payments out of your checking account. That can be rent, utilities, payroll, paying the loan back to the bank, a withdrawal of capital back to the owner. That's money going out of your business checking account. We got to account for all those transactions on a month-to-month basis, and we're going to show that in one of the templates in this presentation. And to make it a little bit more insightful and more big business friendly, it's not a bad idea. It's not required, but I think it's a good idea to make it even more professional, is break out all cash flow, inflows, outflows between operations, that's operational, sales, operating expenses, investments in fixed assets or sale of fixed assets, and the third category that we lump everything into is financing. That's loans, contributed capital, or money withdrawn, paid back to the owner. So we'll break out all the cash flows into 3 main sections to make it look real professional, just like the big corporations do. So let me just summarize the accounting model. This is the last slide. So you should, at this point, I want you to make sure at this point you understand the accounting model, the 3 financial statements. There are 5 major types of reporting categories of transactions in every business model: assets, liabilities, equity, revenue, and expenses. Then we further break it down into what they call a general ledger chart of accounts. So when I say accounts, I'm talking about cash, your business checking account, inventory, equipment, accounts payable, a bank loan, loans payable, the owner's capital, retained earnings, which is a special account where we'll use to close out the income statement, sales revenue, customers, and all the different operating expenses in running the business. That can be legal, rent, utilities, payroll, marketing, all that. You list all those out. They form the chart of accounts. That's the structure skeleton by which we generate the 2 primary financial statements, the balance sheet and the income statement. So think of it this way: cash flow basis, money goes in and out of your business checking account. So if money's deposited into your business checking account, where the hell did the money come from? Did it come from a bank loan? Did it come from a sales to a customer? Did it come from contributed capital? Oh, it came from a loan to a bank. Okay, so I'm going to go to account 2.2, loan payable. I'm going to deposit the cash and classify it as loan payable. So that's a transaction that you will record, and that helps form the balance sheet. And that likewise, the income statement's the same way, right? If money goes out of your business checking account, let's say it's $650, and you spent that money on Facebook advertising. Okay, that's a marketing expense. That would be 5.3 marketing expense, and that's how I'd classify that cash outflow. This is how the accounting model works. There's a structure to it, there's a process to it, You need to understand it. So at this point, you should understand it. And once you understand that, then we can get to the 8-step process. So we're going to go now that I hope you understand the financial statements. I want you to understand the 8-step process for preparing the financial plan. And there are templates that we're going to go through. And the templates are in the Excel workbook. Again, you're going to download that from startupfinancialplan.com. All of this, the PowerPoint, everything, including additional resources, AI tools, they're all on the web. They're all listed on the homepage of the website. It's a quick, fast, one-page website so you can get started and get this done. So the startup cost, you're going to have to ask some critical questions. This is kind of the basis. The basis of estimate for preparing the financial plan requires that you come up with answers to certain critical questions. One of which is, how much do you think you can sell? How many widgets can you sell? How many hours can you bill out? Over what time frame during base year 1? Maybe the first couple of months it's 0, and then maybe in June or July you finally get started in the summer months where you have maybe 50 cupcakes that you sell in your bakery, or maybe by July you've gotten 10 therapy sessions as a therapist. It usually slowly ramps up, but you've got to take your best guess on what you think you can sell. And I got to cover a period of time that I cover all of the expenses until you get to break even. Like if I'm opening a restaurant, I may not get to break even for 12 or 18 months. So I got to cover 12 or 18 months of operating expenses. That means I got to cover the waitress's salary. I got to cover the food supply cost, the lease payments on the restaurant facility. So you got to cover this until you get to break even. So there's a lot of money to fund and finance a startup. So you need to really understand the time frame involved, which is usually operating expenses. And you may have also some one-time expenses. Some people are just professional service firms. Maybe you don't have a lot of one-time startup expenses. It's not that much. But if you're starting a restaurant, you definitely have some big one-time expenses to do the build out in the facility, the restaurant equipment, the furniture, the fixtures, the tables, the chairs, the lighting, the wiring, the restrooms. All that has to be built out to launch the restaurant. So you have some big one-time expenses for a restaurant. And then you have your monthly operating expenses, your lease payments, your rent payments, your utilities, your payroll, your food supply cost, everything that goes into running the business. And I got to cover a time frame to get to break even. And that's a lot of money. How much total money do I really truly need to raise over the long run? Because that's going to map up. If I know that time frame, that maps out the funding plan, which is step 2. Because that funding plan has to cover that whole time frame. How much funding will I need and when will I need it? And then the sales revenue number is a function of volume times price. So how much do you sell at what price? And the price is typically determined based on the marketplace. Your competition in the marketplace sets the price, and that's usually a little bit more objective and easier to figure out. So once I understand these critical questions, let's just say I'm starting a restaurant. The build out of the location might cost, let's say, $15,000 plus $25,000. Let's say it's $40,000 one-time expense. I got to pay lease payments. I got to pay the waitresses, the managers. I got food supply costs of $13,000 a month. The rent's $4,500 a month with the facility. I got to cover at least 9 months of operating expenses. I've got a good lead generation list. We've got good market traction already online before we open. We think we can turn it around. We got a great location, but I'm going to have to cover 9 months of operating expenses. So if I add up 4,500 plus 16,000 plus 13,000 and I multiply that by 9, I got to cover a lot of money. And if I add up my one-time startup cost of 40,000, I really need about 450 $54,000 to cover this whole thing. So I got that one time and those recurring expenses. That adds up a lot. And you got to remember, if you're going to get a bank loan, you're going to have to put up 20% of the money. So you're going to you need to come up with at least $94,000 for the bank to even think about giving you a loan of $360,000. So this is what you have to think about when you prepare a financial plan. And then the hard part is figuring out the real difficult hard part is how much do you think you can sell? How many tables can I turn in the restaurant? How many cupcakes can I sell? How many therapy sessions can I do? That's the real extremely subjective part of this whole exercise. The most subjective thing in preparing the financial plan is determine what you can sell, your volume. And I don't have an easy answer, but we're going to talk about that in depth later in the presentation. But these are the critical questions you're going to have to answer. And then we're going to have to document all of this. You got to document your one-time expenses plus your recurring in a template that's in the financial plan model that you can download from the website. And I got to get the first customer as fast as I can to get out of conceptual stage, because that's going to make it easier to execute on the funding plan, which is in step 2. So this is part of your strategy right here. And I got to get to break even, and that could take a long time. And for your information, the IRS says you need to get to profitability within 5 years. The Internal Revenue Service says if you haven't generated a profit after 5 years, we may consider this a hobby and not a business. So there's a 5-year window that you're working at in order to get to at least get some revenues coming in to satisfy the IRS within 5 years. So, but if you can get to break even in 5 years and have profitability, then you're less likely to get pinged by the IRS, which basically says at least 3 of the 5 years have to show a profit. Otherwise, we think it's a hobby. The IRS is somewhat lenient, but you need to understand the rules that the IRS has when it comes to getting to profitability. So we got to cover one-time expenses and month-to-month expenses. I mean, like if you have a restaurant, you got lease payments, you got to build out the facility. Maybe you're developing a product. There could be R&D, research and development costs that you're going to incur before you can finalize the design and launch the product. Purchase restaurant equipment or vehicles. You got to build out your inventory first, maybe land some inventory for resale if you're a merchandise business. So these are examples of some of the expenses you'll need to cover. And we'll see details as we get into the templates, but we've got to have templates that basically cover the one-time expenses and operating expenses. And the other thing that I think is useful is a third component to include is a contingency reserve. Because I can't really estimate with extreme accuracy what my real true startup costs are. There are going to be some unknowns. So it's a good idea to include maybe a contingency reserve, and the templates have a table to help you calculate that and some rules to follow. So the first step is, what are the one-time expenses you need to make? Is it a building? Well, if you're going to have a building, you have to acquire a building. How much is it going to, what's the acquisition cost? The acquisition cost of the asset. $15,000 for land, $220,000 for a building, and et cetera, et cetera. Every business will be different, but this is just an example. But this is one of the templates you're going to have to fill out in the Startup Financial Plan model that you can download from the website. So one of the template step 1A table template is to fill out the one-time expenses. And we also have useful lives, which are usually defined, like a building is depreciated over 39 years. Furniture and fixtures can be 5 to 7 years. 7 years. A vehicle is usually 5 years. And if you divide the useful life into the acquisition cost, that's the depreciation amount for year 1. So it calculates that for you. And sometimes you may have even more detailed breakouts. Like if you're going to go out and launch a restaurant, and you have a lot of one-time expenses, then you need to maybe break that out and figure that out as well. And this is an example of where a restaurant might need to figure out detail expenses for their one-time build out as well as furniture and fixtures because there's a lot involved. So depending on your business model, you may need some additional detail templates to help support your estimates. The second, the next table would be the recurring monthly. So the second step 1B in the financial model template is to capture all the operating expenses, rent and utilities and payroll. And it'll vary. Then, I mean, these are just examples that are in the sample template. There's a sample template that has a complete example, and there's a blank template that you fill out. And you can choose which one you want to use. Again, download it from the website. So these monthly expenses will be filled out in this template, and then the next step is to add a contingency reserve. And that contingency reserve depends like let's just say you're opening a restaurant. You have no experience whatsoever in opening a restaurant. Then you're going to run into a lot of unknowns, and you need to have a rather large contingency reserve, probably like 40%, 45% maybe even. But if you're a real estate guy and you build houses for a living, you've built these houses for the last 15 years, and there aren't a lot of unknowns, you've got it nailed down exactly, then maybe your contingency reserve is real low. Maybe it's only 8%. So this contingency reserve depends on your experience, how well you're comfortable with the numbers. I mean, there's a lot of things that go into it, but that's step 1C that you'll see in the template, the model that you can download from the website. So I've got one-time investment, step 1A. I've got operating expenses, step 1B, that covers all the way through break even. And then I can add a contingency reserve. It's optional, it's up to you, but I would recommend you do it so that you can have a real true total estimated cost to launch the startup business. And in this example, it's $446,160. So that's step 1. So let's go to step 2. Now that I know the total life cycle startup investment I need to make, what do I need to fund it? Well, you got 3 choices, basically. And I usually would recommend you work left to right in funding your business. Try to put as much of your own money and equity as you possibly can. You need to work this bucket first and foremost because you're at risk. You don't have any customers. You're a startup. You're conceptual. That's an idea. I don't know whether this is going to make it or not. So it's high risk. So you probably are going to have a hard time going out and getting money from other people. So you're going to reach out to family, friends, yourself to fund through equity, and then maybe if you've got something really well thought out, you got good connections, maybe you can go to a local funding agency, maybe you can get some grants. If you got a large social media following, which is great, maybe you can leverage that through a crowdfunding campaign. So you can generate some income to help fund your business before you even get to sales revenue. Now, any income you raise, like through crowdfunding or grants, probably will be taxed as other income on the income statement. But I wouldn't worry about whether you can get taxed or not. Just go out and raise the money. And then the third option to raise money is debt, liabilities. But we don't usually like to go out and borrow money until we really have first customer. Get the first customer first. It makes it easier to secure debt financing, which comes usually from banks, credit unions. Maybe you have outside equity investors you can bring in. Sometimes they come in under what's called a convertible note, which means they might come in under a debt arrangement that converts to equity at some point once you figure out what the business is worth. Or maybe it's deferred equity under what's called a SAFE agreement, simple agreement for future equity. So these are your options. These are the basic options for funding the startup costs in step 1. Okay, so and you're going to have to fill that out and make that in step 2A, and the financial model templates. The model has to be filled out. Okay, how are you going to fund this thing? And you got to itemize all this out and cover as much of it as possible. And some of this might be through income, and some of this is through debt. So there's three buckets you're going to pull from to completely fund it. And then you're going to compare, okay, what were I compare the two and how much is the shortfall, because you're probably going to have trouble funding the whole thing. It's not going to be easy. So you may have a shortfall, and that may mean you may need to revisit and revise your plans, and maybe you need to kind of pare it down a little bit to reduce this. So this is this is the first big reality check in this whole process of financial plan for a startup business. And so what do I do? Well, Matt, you just gave me some bad news. I found some bad news when I went through this exercise with the first few steps in your financial model templates that you have from your website. I went through it. What am I supposed to do? Well, maybe you can reduce and scale back some of your startup expenses. Maybe you don't open a big, huge restaurant. Maybe you do, I don't know, a pop-up to scale and build customers first. Or maybe you move, incrementally through maybe a farmer's market type of thing. You sell your products at a farmer's market just to get some market traction and perfect the design and get a social media following first, and you move incrementally. It takes longer, but you'll protect your risk a lot better. Or try to get some type of commitment from potential. Maybe it's a memorandum of understanding, an MOU. An MOU is a memorandum of understanding that says I've got a major customer who will use my services, and you document that and you put it into your business plan so that the lender feels more comfortable of giving you money, a soft commitment. We call those soft commitments. Or you can partner with investors and other people who can help you. Maybe there's an angel investor, there's an angel group, or an angel group in every major city in the United States. Go out there and network with these people and let them know what you're trying to do. And the fintechs, are a little bit more flexible than traditional banks. Maybe you can get a little bit of startup seed capital from a fintech, a SoFi bank or someone like that. Or if you have major vendors and commitments, maybe they can extend future payments, and you can maybe negotiate better terms so you can kind of stretch this out a little bit further. These are just some possible ideas to adjust to get this thing in sync, so your funding plan is more in line to the startup cost in the first steps of the financial model process. So that gets us through steps 1 and 2. Now we're going to go through the steps that are necessary to prepare the 3 financial statements. The income statement will be first. The balance sheet is rather tedious because we've got to go through a bunch of entries, and the cash flow statement's really easy. We just go back to step 6 to do that, and the gross assumptions are pretty straightforward. So let's go through estimating revenues first. So this means you got to figure out what you can sell at what price. And the price is usually determined by the marketplace. Go study the competition. The price is determined by the marketplace. The subjective part, the extremely subjective part of this whole exercise. What can you sell in base year 1? How many houses can the realtor sell in year 1? How many therapy sessions can you do? How many projects can the programmer do? How many roofs can you repair? How many floral arrangements can you sell from your floral shop? I don't have an easy answer, but you got to figure out what you can execute against. I mean, if you're working full time and you're doing this on weekends, then it's going to be real low. So you know what you can execute on, and you got to be conservative, because you got to be realistic. You got competition. The economy is slowing down. You only have so many resources. You don't have a lot of experience. You got to factor all this in. You got to be honest and realistic about it. But this is your best guess on what you think you can do, and that gives me the estimated sales revenue number for year 1. So we're going to fill out the template. And it's basically simple. The templates are in the model, and it just simply says volume times price equals sales revenue. If I sell one product and it sells for $1,200, that's $1,200 of sales revenue. In February, I sold three. That's $3,600 of sales revenue. We're going to break this out month by month by month by month. And once I figure this out, then below there, I can start to figure out all the other expenses, and that'll drop me into the income statement. Okay, and if you have, well, this is going to be very tedious. Well, maybe you can aggregate everything together. Maybe you don't have to figure out every meal or cupcake you sell. Maybe all the cupcakes are aggregated together, or maybe that you just look at tables turned in a restaurant. Try to get to a sizing parameter that's manageable in the financial model, so it's not so that it isn't too tedious. Okay. So, but this is what you're going to have to do to figure out sales revenue and fill out the templates in the financial model. And we want to defend this. I mean, it's not a good idea to say, well, I can, the market for selling yo-yos is $100 million, and I think I can get 2% of that market. That's a top-down estimate for sales revenue, and most investors and most people in banks don't like that. So we want a very, very detailed estimate that is going to be reflected in this template that we have in the financial model, a very detailed bottoms-up estimate. And if you're having trouble with that, well, look at similar businesses that compete with you. For example, you can go to the public library and get access to financial databases that give you this information. Or maybe you have a really good lead generation list that's already prepared of prospects, and in your industry, the conversion rate's about 5%. Or maybe you have a really good team and experience where you've executed in the past. These are strong selling points to defend. I need to defend your sales forecast. Maybe you have a successful crowdfunding campaign that you've already launched and you perfected the design of the product. I need some proof points that defend the sales forecast I wanted to put into the business plan, so that when the person gets to the financial plan, they're more comfortable with it, okay? So this is some of the things I want you to put into your business plan so I have a defensible sales forecast. So I've got the sales revenue estimated by months, volume times price. Again, volume is real subjective. Take your best guess, month to month. Price is the marketplace, okay? And I want it to be defensible per some proof points in your business plan, okay? So let's talk about expenses. The expenses are broken up into two big buckets. And we have expenses that are directly associated with delivering the product or service to the customer. Typically, that's called cost of goods sold. Some people may refer to that as variable expense. And then I have month-to-month operating expenses that are indirect. They're not directly related to the product or the service at all. Like paying insurance every month has nothing to do with the product or the service, or rent, or accounting fees, or legal fees, or whatever. And these expenses, the operating expenses, don't vary much month to month. So a lot of people will refer to those as fixed expenses. So we have two major categories of expenses on the income statement. And we want to prepare a detailed bottoms-up estimate if we can. It's rather tedious. So if you make blue jeans for a living, how much fabric would go into making the blue jeans? How much time did the seamstress take to make the blue jean? Well, it took her 20 minutes to make the blue jean. She's paid $18 an hour. 20 minutes divided by 60 minutes hour. 20 divided by 60 times $18 an hour would be the direct labor cost to make one pair of blue jeans. This would be a very detailed bottoms-up estimate. But you say, oh, I don't have time to do all that. Well, then maybe you do a rough order of magnitude estimate, and we can use industry benchmarks for your respective industry. By the way, every business has a 6-digit code that describes what that business industry code is. It's referred to some people will call it the NAICS code. That's NAICS, North American Industrial Classification System number. If you know what your NAICS code 6-digit number is, that's the industry you need to zero in on for your benchmark data. When you fill out your tax return for your business, there's a 6-digit activity code. It's the same thing. The NAICS code and the activity code on the IRS are the same thing. That is the specific industry code that you're going to go in and research at the public library from their databases to figure out the benchmarks if you want to do it this way. That's how you're going to do it. You're either going to do a detailed bottoms-up estimate, you're going to use your NAICS code or activity code, your 6-digit code, you're going to go to the library, use their databases to figure it out from the industry benchmark way. That's how you're going to do it. But if we do it, the templates are set up both ways. There's a template to figure it out the detail way. Like if I'm going to land, let's say I'm selling portable battery units and we hire some labor to assemble it. It's $360 to assemble one unit. One unit. It's going to take $360 of labor. I mean, $360 of materials, I should say. So I got to get the materials, assemble it. The labor costs $140. And then we have some factory overheads, $240. So for one unit, the actual total cost to make that one unit is $740. So that's the detailed bottoms up way. Or if you want to do it based on your NAICS code, if you say you know what your NAICS code is and you figured that out and it's small manufacturing of equipment, and you look it up in the databases at the library and it says, okay, and they'll show you what the financials are for your industry. And it says the gross margin is 35%. Then you have to figure out what you're going to sell it at. I'm going to sell it at $1,250. That's the market price. Then I can calculate the gross margin, and the cost of goods sold per unit is $813. So 813 is that's the benchmark method versus the 740 is the detail method. They're not exactly the same, but they're close enough. But you got to decide on which one you're going to use. That's going to be the baseline for costing out the products as they're sold in the financial model. Okay, so that's a very important point. And then again, we have CapEx, capital expenditures, and operating expenses. So if you have a capital expenditure, it's a one-time expense. These are the useful lives. See, there are 8 different types of assets typically that you might see as one time. These are the useful lives for depreciating and writing them off in your balance sheet. And then the income statement will be pre-populated with a lot of different operating expenses, and we'll cover 12 months or less. Maybe your rent kicks in June or July or August. I mean, you got to map it out in the template, the financial model, according to how it shows up. Again, this is all in the templates. You're going to figure all this out. Again, there's a sample template that has everything pre-populated as an example, and then there's a blank template. Again, you download all of this from the website, reference at the bottom of the slide. So now that I've got revenues and expenses figured out, now just put the income statement together. And again, it's all in the templates. It's all in the financial model templates that you're going to download from the website. And we'll break this out by months. There's a month breakout version, but there's also a print-friendly compressed version that breaks it out on a quarterly basis because it's kind of hard to fit. It's really hard to fit all this into a standard 8.5 by 11-inch piece of paper. So you can do it either way, but right now it's set up to print the compressed version, but you also have the detailed monthly version, so you have the option of using either one. And it's easy to print off the compressed version because it's already, the print range is highlighted for you. Just hit the link and then you hit file print and you're good to go. So that's that. And just be advised, I kind of gave you a simple version of the expenses and the income sales revenue less expenses, but there is a possibility. You could have some non-operating line items in the income statement. For example, maybe you sell off some of your restaurant equipment. That's not exactly an operating revenue number, it's an operating income. Or maybe you get a grant or you get pitch competition, and that's other income that's going to be reported on the income statement. It has nothing to do with your operations, your day-to-day operations. So you might have some line items that are non-operational, and same with the expenses. Depreciation is not really an operating expense per se. The interest you pay on your loans are really non-operating. And if you're a C corporation, you'll pay corporate tax. Most of you probably are limited liability companies. You're pass-through entities, so you won't have corporate tax. We will talk about taxes here for the next slide. Now, let me make a point because it's a little confusing. You might say, well, you're kind of confusing me with taxes. If you're a limited liability company, your tax designation probably is going to be sole proprietorship, partnership, or S corp. Those are pass-through entities. What does that mean? I don't know what you mean by that. That means whatever the profit or loss is passes through to the personal tax returns of the business owners. Okay. But what you need to be aware of, even though you say, well, I'm not paying any taxes as the business entity is not taxed like a corporation because it's a limited liability company. Well, okay, I got it. But what you need to be aware is you're still going to end up paying taxes on your personal tax return. So let's just let's just go through an example so you really understand this. Once you start to actually earn an actual profit, and let's just say, for example, you need to withdraw $65,000 every year to live off your business. I need to take $65,000 out of my business every year from the actual profits so I can pay my personal expenses. What you need to realize is you need to set aside probably 25% of the profits because you've got two silent partners you have to pay, whether you like it or not. I'm sorry. When you go into business in the United States, you have two silent partners that have to get their cut of the profits. That's the IRS and the state. And the state is state income tax, and you have to pay federal income tax on the profits. And the big one is self-employment tax. That's Social Security and Medicare, and that's 15.3% of your profit number. And you probably need to leave a little bit of cash in the business to grow and keep it going forward. So let's just say it's $5,000. So if you need to take $65,000 out of your business to support yourself, you're going to need to make $110,000 because I got to pay the IRS and the state, and I got to keep the business going and the lights on. So $5,000. So you really need $110,000 of profits. So just make sure you understand, even though the business entity's not paying any profits or paying any taxes on the profits, you yourself personally are going to end up paying some taxes. So you need to set aside 25% of that to cover the taxes. Okay, so just keep that in mind. So that raises an interesting question. And here's I'm going to kind of give you my opinion on this. And this is just my opinion. And I'm going to give you my opinions, and it's my opinions and my opinions only. But for most people in the United States who run a small business, you need to focus 50% or more of your time trying to sell because it's the volume lever that you have to pull on the most. I mean, you only have 3 levers you can pull on to increase profits when you look at the financial model. You either increase the volume, you increase the price, or you lower the cost and expense. That's it. Because volume times price equals sales revenue, and sales revenue less the cost and expense is the profit. So if you want to run the financial model and you want to increase the profit, you only got 3 levers you can pull on. You can increase the volume. It means you need to spend 50% or more of your time touching customers, potential customers, talking to existing customers, figuring out what their pain points are so you don't lose them. I mean, if you're spending less than 50% of your time on customers, then you know what? Oh man, I don't know whether you can execute on this financial plan. So I'm just giving you a hard opinion here on this slide. Also, I'm going to give you another opinion that I think the best lever to pull on is price. Because it's hard as hell to go out there and sell and pull on the volume lever. It's hard. But I can tell you, if you can pull on the price lever, it's a lot easier. But that's not easy because the customer has to recognize that you are providing exceptional value that wows the customer to such an extent that they're not sensitive to price increases. So another rule I think you need to be aware of, and this is an opinion, don't ever be a minimalist in what you deliver to the customer. Go above and beyond what it takes. So the customer is so impressed, they want to go back and use your service again. Or maybe they have a talkable experience and they tell other people about your product or your service. Like let me give you an example. I subscribe to something called Spotify because I love the music app. I love it so much. There's nothing like Spotify when it comes to music streaming. Spotify increased their price a little bit a few years ago. I didn't care. I love it so much. I was not sensitive to price increases. So you want to increase the perception of value. The other thing I would tell people is don't ever offer the customer only one choice. Give the customer multiple choices and options. It will raise the perception of value. So someone comes over and does a landscaping project on my house. I have 3 people come up and give me a bid. One of the companies gave me 3 choices on landscaping my yard. That's the person I end up choosing. Conversion rates go up when you give people options and choices. Okay, so that's how you pull on the price lever. So you work like hell on marketing and selling to pull on the first volume lever. Price means you have to be exceptional, raise perception of value. Giving options and choices can help. And then the third and final lever is try to lower the cost. Maybe you make blue jeans for a living, and instead of $18 an hour for a seamstress, you find that I got some Hispanic women who will work for $15 an hour to do the blue jeans. So maybe you can find some ways to lower your cost. Okay, but those are how that's it. That's how you're going to increase the profits of the business. At this point, we have the income statement done. Now comes a rather tedious step 6. Because unfortunately, to do the balance sheet, I have to work through the transactions. And there's no easy way to do it. So this is the tedious step. So in order to do that, I've got to set up basically a listing of chart of accounts. Remember that I had a slide that showed you the structure, the chart of accounts. You need to map out literally all the different transactions that are going to go through your business. The template has basically a chart of accounts that works through the most common types of transactions in your business. And you're going to work through this chart of accounts and transactions that generate the balance sheet for base year 1. There are 2 accounts that are a little unusual. One is accumulated depreciation. What that means is I need to accumulate depreciation to write off the fixed assets year to year to year, and then eventually I want to close out the income statement to an account called retained earnings that will appear in the equity section of the balance sheet. So this is what we're going to do, and we're going to have to work through month after month after month of transactions. Like when a customer pays you for all the sales, sales revenue will generate cash inputs, cash deposits to your business checking account. That will be on the debit side of the cash account. As I pay money out, that's on the credit side. So if I'm paying for, let's say, operating expenses, $6,670 in the month of March, that decreases the cash. The thing that you need to be also aware of as you work through these transactions through the template, again, I would go through the sample workbook so you can see how this works. You need to kind of pay attention. See where you need to pay attention to this cash balance. Because if this cash balance turns negative month to month, then you need to revisit your funding plan, and maybe you have to put in a line of credit. You got to revisit the funding plan, and I add a line of credit so that this doesn't go negative. That's what you need to work through. So what you will find invariably as you work through your transactions to prepare the balance sheet, there's a very good chance you're going to have to go back and rework the funding plan a little bit. Okay, so this is the tedious part of the exercise. But you have to post the transactions, and again, you have to work these balances. And as you work month to month to month, then toward the end, we're going to accumulate depreciation, a catch-up entry, so we can write off all the fixed assets. That's one of the steps we'll do toward the end. Again, most of the transactions are probably going to fall into these buckets. So for most of you, you're probably going to have 6 types of transactions that work month to month to month to get to the balance sheet. This is a rather tedious part of the process. This is the tedious part of preparing the financial plan. But the good news is, once we get this done and it helps us finalize and revise the funding plan so it's really an airtight model. So the good news is, as I get through this and I have shortfalls in cash, like I do here maybe, so I have to do additional funding. We had to come up with $50,000 of funding. And maybe we went through the Economic Development Corporation. We have people we know. We believe we can secure some funding in March, drop the money into the business checking account in April. Otherwise, we're going to have a negative cash balance per our financial plan. We want an airtight model so we don't have leaky holes. And this is the tedious part of where we really this is where we nail down the airtight model for the funding plan and the balance sheet. The balance sheet is the critical, tedious part of developing this. But the good news is once we get to the end, we check to see that all the debits and credits all come across the 2 financial statements. Remember I said there's 5 types of financial transactions: assets, liabilities, equity, revenue and expenses. And when you post it to those 5 major groups of accounts per the chart of accounts, which is off to the left of this template, then these total debits, if I add them all up, they balance out. And the difference between the expenses and revenues is a profit or loss. And this number will be closed out to the retained earnings account, and that's it. Once you get that done, congratulations, you can celebrate. You have created an airtight model for base year 1. You can rock and roll and celebrate at this point. And the cash flow statement becomes real easy to do. So, and you can close it out with the retained earnings account. You can see where we closed it out, and it all balances out. Assets equals liabilities plus equity. That's referred to as the accounting equation, and it all balances out. You got an airtight model. So, and just a few things. You remember you have to write off your tangible assets. Your intangible assets are amortized. We kept it simple, and we just wrote everything off through depreciation in our example or sample model. And remember, you have to make loan payments back. You have to close it out. We're going to zero out all the revenue and expenses, the difference, the profit or loss is closed out to retain earnings. I notice some people do something which I think is a very bad practice. And even SCORE does this, and I don't like it. Some people actually plug the equity number by subtracting out liabilities from assets and referring to it as net worth. This is not a good idea, so I would refrain from that. Remember, the valuation or worth of your business is more linked to the income statement, not the balance sheet. And there's a number called EBITDA, and you can look that up. Earnings before interest, taxes, depreciation, and amortization. And that's the benefit stream that typically is assigned and used to assign valuation or net worth of a business. And remember, when we raise money, not all of it is equity. There could be some other income, like if you do a crowdfunding campaign or a pitch competition. So these are just some finer points. And the balance sheet is done. That's tedious, and the cash flow statement becomes real easy because now all I got to do is go back and look at the cash account per the previous step and just compile that information and maybe break it out a little bit more detailedly. And I would also recommend, you don't have to, but it's nice to break it out into 3 sections: operating, investment, and financing. And we fall back on the previous step in the balance sheet to compile all this to show the beginning balance. Then we show an ending balance at the bottom of this, and the ending balance for January becomes the beginning balance for February. And we work through 12 months of this. And it works out really well once you get through the balance sheet. And some additional points, if you've got seasonal businesses, you have slow periods, you may need to provide for cash cushions. Also, you need to recognize that some of your cash collections may be lagging, which means if you send an invoice out for professional services, it's possible you may not get paid for 30 or 60 or maybe even 90 days, especially if it's a government contract. And some of the month-to-month operating expenses aren't really month-to-month. They're going to hit your business checking account maybe a little differently. For example, maybe if you pay vehicle insurance every 6 months, that's going to hit your cash account every 6 months. But maybe on the income statement, we broke it out monthly. So there could be a little bit of difference there. Also, I would recommend you establish a line of credit as quickly as you can, because you need to cover month-to-month operating expenses through your line of credit. And the best time to ask for a line of credit is when you don't need it. Don't ask for it when you're desperate. Try to get it done when you're doing it. And know what your runway is, your burn rate. So if you've got, let's say, $50,000 in your bank account and your burn rate's $5,000 a month of operating expenses, then you only got about 10 months before you run out of cash. So you need to kind of understand that. If you run a professional service business, manage your receivables, and you want to turn your inventory over as quickly as you can. Otherwise, your cash is tied up in inventory, and we don't want that. So these are just some finer points for cash flow management. The final 8th step is to get your assumptions down. If you go to the sample template, it gives you specific examples of how to do this, but you're probably going to have at least 2 assumptions. Obviously, you're going to have probably an assumption: how much do you think you might be able to grow your sales revenue in the out years? Well, maybe let's just say I take an average of what I sold last year in base year 1, and the average monthly sales, I sold a total of 1,015 units. It covered 7 months. The average unit sold was 145,000. I think we can increase the sales revenue in from base year 1 and year 2 by 6%. So maybe that's an assumption you say for growing it. You'll also probably make adjustments to your operating expenses. Maybe the rent gets increased by 3%. Maybe you want to spend more on marketing. Maybe you want to change your product mix. I mean, there's lots of things you can do to change the out years. And once you do that, then you can go apply that against your base year one. And that's what you're going to do. The template's going to show you the balance sheet, but then we're going to apply these assumptions. These are going to become your beginning balances. In year two, you're going to pull off the ending balances from base year one. And then you're going to apply your growth assumptions to this stuff. And that's going to get you to years 2, 3, and so forth. Okay. So and model one is just base year one. Model two has 3 years in it. It's a little more complicated. It has a loan amortization schedule and stuff like that. Here's some additional resources that you can go to. The accounting stuff website is really good. I actually have some specific links in the Model 1 template to help you out. If you actually wanted to build the model from scratch, from an Excel model, and you don't know how to do Excel, this is a really good 90-minute presentation. And again, if you go to the website, which is listed here, you can also download the SCORE alternative models. So I have model 1 and 2, which model 1 is the simplest model you can download. Model 2 is a little more complicated in detail. It has like a loan amortization schedule, and it has 3 years in it. And then the third model you can download from the website is the SCORE alternative model. I think it might be a little too complicated, but it's up to you. There's a blank version and a sample version for all three of these, Model 1, Model 2, and the SCORE model. So again, if you go to the website, it's all there. This is going to get you there. And if you, again, go to the website, there's 3 versions. There's a sample and a blank model. Try to develop the model yourself as much as you can. And if you need help, I'm available. Schedule an appointment. Okay, schedule an appointment. I'm here. I'm retired. I got plenty of time. I'll be glad to help you out. Here's my email address. Hopefully you found this useful. Again, go to the website, go for it. And I enjoy talking to you, and I hope to work with you and help you do your startup financial plan.